The most important thing to learn is how to value a business.
And that is exactly what we'll be covering in today's video. So hello guys, welcome to another video. This is your financial management tutor Uzair Awan, and today's video is going to be revolving around the chapter business valuation of your financial management exam. Now before starting this chapter of business valuation, there are few assumptions that I would be expecting from you guys, and that would be that this is the second last chapter from the in the study hub, right? So I'm going to be teaching this entire chapter from the study hub, which means that after this video all you guys would have to do would be to revise it and then just attempt the question, and then this chapter would be completed, because in this video I'll be covering everything that is present in the study hub for this chapter, which includes the calculation parts also and the theory part also. So that means everything would be covered in this video. All you guys would have to do after watching this video very carefully and till the end is just to revise it and then attempt the question, and that's it. This chapter is done. Now this is a very important chapter, and what I said previously about assumption was that this is the second last chapter in the study hub, right? So before that there are a lot of chapters that are covered, so I do assume and I do expect from you guys that you guys would have covered all those chapters before watching this video, because in this video there are going to be few things from the previous chapters which would be linked to the previous chapters. So I'm not going to go into detail for that, because again I am assuming that you guys have already studied those chapters and now you have started with business valuation, and now let's start with it. So as you guys can see in this diagram, that this chapter is around business valuation, which means that you are going to learn how to value a business. And as you can see that there is no one particular method to do that. There are many methods that you can use to value a business depending on the nature of the business and the industry it operates, right? So the first thing is you can value your business based on its asset, which is called asset based valuation. Now in the asset based valuation you have the net book value option, you have the realizable value option, and you have the replacement cost option. So these three comes in the category of asset based valuation, whereas the second option that we can use to value the business or any business is based on its earning or its income, right? So for that you can use the PE ratio. There's a PE ratio method, there's an earning yield method, and then there's a dividend yield method, right? So these three comes in the category of valuing your business based on the income or the earning, okay? Then you can even value your business based on the preference shares, and then last but not the least you can value a secured. So you can use that in order to calculate the value of the business. Okay, so this is the entire summary of this chapter. This is what the chapter revolves around, and now let's start with the very first thing, which would be asset based valuation. So in the asset based valuation, as you guys saw, that the first thing or the first method that you can use is the net book value. Okay, so what is net book value method? Net book value method is very simple. It uses the balance sheet equation, which is also called the accounting equation, to value any business, right? So if you want to value any business based on its net book value, all you have to do is to take the assets of that business and subtract liability from it. So if you take the asset of the business and subtract all the liabilities from it, you will get the equity, which you assume to be the value of the business. However, this method has some problems and weaknesses. For example, number one, you can see that it is using historical cost, because obviously assets and liability both comes from the balance sheet, and you guys know that balance sheet is based on the historical cost. So that's exactly what they're saying over here, that balance sheet values, example the carrying amounts, are often based on historical cost rather than the market value. So therefore you are using historical cost to value a business, which is one of the weakness of this method. Okay, the second method is that it uses accounting policy, because again balance sheet uses accounting policy like depreciation, amortization, which is subjective, right? Any company can decide what depreciation method they have to use. They can use straight line method, they can use reducing balance method. Similar is the case for amortization, right? So these things are subjective to the company and therefore they vary. Okay. And like we have studied before, that some directors of the company, they choose a specific type of policy just so that they can get more profits, through which they get their bonus or they get some kind of reward, right? Because their performance is related to the profit of the company, correct? So accounting policies is being used. That is again one of the weakness of this method. Then the third weakness of this method is that there might be unrecorded assets which are not taken into account while valuing a business. For example, your internally generated goodwill will not be recognized. Now we know that we do not record the internally generated goodwill, right? So if we do not record the internally generated goodwill, you guys know that this is a very important thing, because a company's goodwill is something which matters, right? When you're trying to value a business, goodwill matters, right? So if you're not taking into account the goodwill, which we do not take into account, we do not record internally generated goodwill in the balance sheet, we do not do that. So if you do not record that, then again you're valuing a business excluding the goodwill, which is obviously one of a very big weakness, right? And then the market condition, there is no consideration of market condition or the company's growth potential, which are crucial factors in share valuation. Obviously, whenever you are valuing a business, one of the key component to value a business is to check what's the company's growth potential, right? In the coming years or in the foreseeable future, how do you see the company, right? How do you see the growth of the company, right? It's a very important and crucial component to decide valuation of a business, right? So if you are ignoring that, which you are in this method, so again that is problem, that is a weakness, right? So these are the problems and the weakness of using a net book value to value a business. Therefore, that's what they're saying over here, that because of this weaknesses and problems, a share valuation based on balance sheet net assets is unlikely to be suitable, right? So they are saying that is why it is unlikely to be suitable, because of these weaknesses and problem, and that is why this is not a very popular way to value a business. Okay. The second method that we have on our list is the net realizable value method. In the net realizable value method, what you do is, it's the same like the net book value. The only thing is that over here, instead of taking the balance sheet value of the assets, what you do is that you take the net realizable value of asset. Now what is a net realizable value? You guys might know this already because we have studied this in the previous papers. That what is an NRV? NRV is basically the selling price minus any cost incurred to sale, right? So you just take the selling price and you subtract from it any cost that might be incurred to make the sale. And once you do that, then you have your NRV. Once you do that, then you have your NRV, right? That is exactly what's written over here, that what is NRV? It's the estimated selling price less the estimate cost necessary to make the sale. Okay. So once you have your NRV of the asset, you subtract that NRV with the liabilities, and that's how you get the value of the business or the equity. Okay. So this is the net realizable value method. You can see it's the same as the net book value. In the net book value, we were subtracting the assets value that we get from the balance sheet from the liabilities, right? Over here, the only difference is that you are taking the NRV value of the assets rather than the balance sheet value of the assets. Okay. So you took the NRV value of the assets and you subtracted that with the liability. So you got your value of the business. Okay. Now there are few problems and weaknesses of this method also. For example, if you have to decide the selling price, because you have to calculate the NRV, right? And for NRV, what are the two things you need? You need the selling price and you need the cost incurred to sale. So as far as the selling price is concerned, they are saying that estimating selling prices under forced sale or distressed condition is challenging and not the same as in the ordinary course of business. Example for inventories. So they're saying that if you're trying to estimate the selling price, right, that can be challenging, because again, if you are estimating something, if you're trying to estimate that how much can I get from selling this, selling this product or selling this inventory, then that's an estimation. So if you're using an estimation, that's a limitation on it of itself, right? But again, What it says over here is that if there's a for sale or distress condition, which means that you are, just trying to get a selling price very quickly, immediately, you just want to get rid of your things and you're just trying to, take up or calculate or estimate any price that you can get. So in that condition, obviously the selling price is gonna be a challenging figure to determine as compared to the ordinary course of business, where you are just, more focused on selling things rather than selling things at a shorter time, right? So that exactly what they're saying, that selling prices are harder to estimate. So that's one, limitation. And again, it's an estimate, so estimate is a limitation of itself, right? Now the second thing that they're saying is that market values, the NRV of some assets may fluctuate significantly if they have volatile market values, example commodities and financial instruments. In addition, it is also challenging to estimate the NRV of assets of which there is no active market. Yes, so if there is no active market for any of your asset, how are you going to calculate the NRV? Because there is no active market, right? This is the point that I explained to my student in while studying the financial reporting exam, right, the F7 exam. And I usually explain this point over there but in very much detail, right? So the point is that if you do not have an active market, right, for your asset, which means that your asset is not being sold in the market on daily basis, right, or it's not being sold, on a regular basis. So that's what we call not having an active market, right? So if your asset does not have an active market, if it's, a one of a thing or something like that, then how are you going to calculate the NRV of that asset? Because you cannot obtain the selling price if there is no active market, right? So this is again one of the biggest limitation of this method. And then the third one says that it ignores the unrecorded asset, example the internally generated goodwill. So this point is the same as the one that I discussed at the above. So this is again the limitation of this method also, that it ignores the unrecorded assets like your internally generated goodwill. So these are the weaknesses and problems of the NRV method. Okay, so now let's move to the third type of the method, which is called the net replacement cost. Now in net replacement cost, how you value a business is that you basically just see the replacement cost. So net replacement cost can be viewed as the cost of setting up an identical business from scratch. So what happens is that I'm going to ask myself that, okay, I am trying to acquire this business and I need to value the business, right? So the one way that I can think about the value of the business is to just ask myself, or it is just to think that what if I set up a similar business, a identical business from scratch. So instead of buying it, now I'm trying to set up a business similar to this or identical to this from scratch, from zero. So how much is that gonna cost me, right? So that is one way that you can, just see the valuation of the business, that okay, if I, set up a similar business having the same number of employees, having the same office, same everything, right? If I do that and I, set up that from scratch, from zero, how much is it gonna cost me? How much funds am I going to need to sustain a business like that or set up a business like that, right? So that cost can be taken as the value of the business. So that is what the net replacement cost is basically all about. So you can see over here, it says that equity is equals to estimated depreciated replacement cost of net asset. This may represent the maximum price a buyer might be prepared to pay, right? So that's one way that this, method uses. And the second way that this method uses is that it says that, okay, if for example I have a lot of assets in my company, so what if I, replace these assets? What if I replace these depreciated assets? Because obviously if you have assets in your company, you will be using them and they will be depreciating, right? So what if I replace all these depreciated assets with new assets, right? So that is exactly what they're talking about there, estimated depreciated replacement cost of net asset. This may represent the maximum price a buyer might be prepared to pay for my depreciated assets. Okay, now the problem and weakness of this method is that it is challenging to apply because there might not be any comparable replacement cost, example unique or specialized asset. For example, if I have a specialized asset, a asset that I have prepared for my company or according to my products or according to my needs. So I have customized that asset. Now if I have customized that asset, that means that there is no other asset, similar asset in the market, right? And if there is no similar asset in the market, how am I going to compare it, right? Because as you can see that this entire method revolves around, comparing that, okay, what if I replace my depreciated assets with similar new assets? So what if there are no similar new assets in the market? How are you going to compare that, right? So this is one limitation. The second limitation is the overvaluation. It's saying valuing old and less efficient assets at current market price of new asset, that you are basically valuing your old and less efficient asset which has been depreciated, which you have been using for a long time, and now they have lost their value because they have been depreciated. So you're comparing those old, less efficient, depreciated asset with the current market prices of new asset, because that's what you're doing over here. That's what I said over here, right? Again, those assets that you're comparing them with are new, right? And they are at current market prices. So again, there's going to be an overvaluation, right? And the third one is the unrecorded assets. It ignores unrecorded asset, example goodwill. So this point is constant for all three methods, right? So you can see that for net book value, for NRV, and for net replacement cost, all these three have the same one problem, and that is that they do not record the unrecorded asset. They do not take into account the unrecorded assets, example the goodwill, internally generated goodwill, right? So these three methods we have discussed their problem. You guys can just give it a plain read, and that is it. That is enough. Okay, so net replacement cost, NRV, and net book value, these three methods, as you guys can see, is the asset based valuation, that you are valuing a business based on its asset. Okay, now we are going to move to the second category, where you are going to value the business based on its earning or its income. Okay, so let's start the second category. And in the second category, the first method that we have is that you can use the price to earning ratio, the PE ratio, right? Now the PE ratio of a quoted company. Now what does a quoted company means? Quoted company means a listed company, a company which is listed on the stock market. Okay, so a published PE ratio of a quoted company, a listed company, takes into account the expected growth rate of that company. Example, it reflects the market's expectation for the business. So those of you who have studied the financial reporting F7 exam might already know about the price to earning ratio in quite detail, right? The price earning ratio basically reflects the expectation that the market has with respect to that share, right? So that's exactly what they're saying, that the PE ratio takes into account the expected growth rate of that company, that what is the growth rate that the people expect from that company, right? So it reflects the market expectation for the business. So if you are using the published PE ratios as a basis for valuing a unquoted mean unlisted companies, that may indicate an acceptable price to the seller of the share, right? So what this paragraph is trying to say over here is that if there's a listed company, right, you can just look at its PE ratio to basically, understand the market expectation for the business. But if there's an unlisted company, an unquoted company, which is not listed in the stock market, how are you going to, value that business based on its PE ratio? So they're saying the way that you can do this is by using these four steps. And what are the four steps? That you select the PE ratio of a similar quoted company. So what I'm going to do, I am looking at an unquoted company. Okay, listen very carefully. I'm looking at an unquoted company. Unquoted company means unlisted company, which is not listed on the stock market. Okay, I'm looking at an unquoted company. Now, since this is not, listed on the stock market, I cannot, have a look at its P ratio and understand the market expectation, because there is no market expectation. It's not listed on the stock market, right? So what I can do is, step number one, I can select the PE ratio of a similar quoted company, a company which is listed on the stock market. So I'm going to look for a similar listed company, and I'm going to select its PE ratio. Then step number two, I'm going to adjust downwards to reflect the additional risk of an unquoted company, because obviously if I take the PE ratio of a similar quoted company, and I'm going to say, oh, because the similar quoted company has a PE ratio of, let's say, 1.5, my unquoted company will also have a PE ratio of 1.5. That would be a wrong assumption. Why? Because unquoted company has a lot of risk. It's not listed on the public, market. It's not there on the stock market. Its information is not public. Therefore, there is a lot more risk in an unquoted company than in a quoted company. So therefore, you have to adjust for that risk also, right? So that's exactly what is the step number 2, that you adjust downwards to reflect the additional risk of an unquoted company. And the non-marketability means that you cannot market it, right? You cannot market unquoted company shares. You cannot market unquoted company shares because the quoted companies which are listed, they can be marketed, right? They are being marketed if they are listed on the stock exchange, because people, come to know about them, that, oh, there's a company, let's say ABC, they are listed on the stock market and they have a share of this much, so we can maybe invest in it. So they learn about that company, they do their analysis, right, and then they invest based on the analysis, right? But if the company is unquoted, it's not listed on the stock market, then it's non-marketable, right? Because people would not, get to know about it. The general public would not get to know about it, right? So that's the non-marketability factor of an unquoted share. Okay, so this is step number 2. Okay, don't worry, we are just looking at the steps, and there is a question below this where we will learn to apply these steps. Okay, so step number 3 is that determine the maintainable earning for the unquotable company's EPS. And the step number 4 is that you multiply the earning determined in step 3 by the adjusted PE from step 2 to find the value of the unquoted company share. Okay, so these are 4 steps. We are going to look all 4 of them with the help of the example. But before I do that, just one thing that you guys need to remember is that, let's say I have the PE ratio now. So is my PE ratio going to tell me that what is the value of the business? The answer is no. PE ratio alone would not tell you that what is the value of the business. Rather, there is a formula that we use in order to determine the market price of the share. Okay, and it is based on the PE ratio. So that is why we calculate the PE ratio, and we use the PE ratio to calculate the market price or the value of the business. Okay, so the formula that we have to calculate the PE ratio is that you take the market price per ordinary share, right? So you take your market price per share, okay, and you divide it by the EPS, which is earning per share. Okay, so this is how you calculate your PE ratio. Now just imagine if I have to calculate my market price per share, or if I have to calculate the value of my business, then I will have to send this denominator to the other side of the equation. So it's gonna be that market price per share is gonna be equal to PE ratio times the EPS, right? So this is what my formula looks like, right? So this is what I do, that I get my PE ratio and I use my PE ratio to times it by EPS, so I can get my market price per share, because again, market price is dependent on PE ratio and EPS, right? So this is the formula that you can see over here. They have also concluded the same formula, that if you want your ordinary share price, you want your market price, you need the valuation of the business, you need to basically times your PE ratio with EPS. Okay, so that's how you get your value of the company. That's how you get the value of your company. Okay, so this is how you get it. And if you want to calculate your EPS, then you just take the profit from the year, you subtract any preference dividend that you might have paid from it, and then you divide it by number of issued ordinary share. Okay, again, something that you guys have already studied in previous paper. Someone who have studied financial reporting F7 exam would know the formula of EPS. He would know about EPS in much more detail, because there's a whole IES 33 in financial reporting exam which covers EPS in very detail. And by the way, I also have videos for that on my YouTube channel for EPS financial reporting exam IES 33. Okay, so anyways, what I'm saying is that EPS can be calculated by profit for the year minus preferred dividend divided by number of issued ordinary share, right? So you can get your EPS, then you can just time your PE ratio with EPS, and you can get your market price per share or the value of the company. Okay, so this is how you value a business based on your PE ratio. But the main thing is that you need the PE ratio. You need the PE ratio. So that is exactly what we are studying, that yes, we do need the PE ratio in order to get the market price or the value of the business. So PE ratio plays a very critical role. Now, how do I get my PE ratio? So for unlisted company, for listed company, for the quoted company, you can easily calculate the PE ratio from the financial statement, and there are a lot of softwares that can give you the PE ratio calculated, right? So you can easily get that. There is no problem. But the problem is that if there's an unlisted company that I'm trying to invest in, how do I get the PE ratio for that? So for that, we have 4 steps that we can apply to, get the PE ratio of an unquoted company, because again, you need the PE ratio to get the market price or the value of the business, right? So that is something that we can do. And here is the example. Let's look at an example before we read the problems and the weakness for this. Okay. So what does the example say? The example say that there's a foodie company, which is a small chain of UK based grocery shops, has just reported post tax earning of $200,000, out of which it paid a dividend of $50,000. The PE ratio of 3 large UK quoted supermarket chains are. Now look at the question very carefully. There's a foodie company. There's a company called Foodie. There's a company called Foodie, which is a small chain of a UK based grocery shop, and it has just reported a PAT, profit after tax earning of $200,000, out of which it is going to pay a dividend of 50,000. Okay. And now over here they're saying that the PE ratio of the 3 large UK quoted listed company, okay, the company that we are talking at the first paragraph is an unquoted company, right? This company is an unquoted company. It's a small chain. It's an unquoted company, okay? And now the PE ratios that we have are for the quoted company, for similar businesses, for similar super chain markets of quoted companies, okay, the ones that are large and they are listed on the stock market and they are very big supermarkets. Okay, so we have their PE ratio. Now why do we have their PE ratio? Because remember step number 1, what do? Because you are unquoted company yourself, so what you do is that you select the PE ratio of similar of companies which are in the similar industry, which do a similar business like you, but they are listed. Okay, so that's exactly what we have. We have listed supermarkets, okay, because we ourselves are also a supermarket, right? That's what it says in the first paragraph, that foodie company is a UK based grocery shop. Okay, so we took similar businesses which are in the same industry of supermarket, grocery shop, same thing, but they are listed, right? But they are listed. So these are their PE ratio: 14.5, 12.0, 17.0. Now obviously I'm not going to take any one of them because that's not going to be fair. So what's the most fair way? The most fair way is that I know 3 companies from the same industry of having PE ratio of 14.5, 12.0 and 17.0. So it's much more rational to take an average of that, right? We can just take the average of these 3. So we are going to get 14.5 average PE ratio, right? So that is the average PE ratio of the industry that I operate in, right? So I got 14.5 as my PE ratio. So if I want to value my business now, what can I do? I can just, take the average PE ratio that I have, because you guys remember what was the formula, that market price per share or the value of the company is equals to the PE ratio, which you got as 14.5 into the EPS earning. So you can see your earning is 200,000 over here, right? So that is exactly what you're going to do, and you have a valuation of $2.9 million. Now remember that this valuation that you got of your foodie company is of $2.9 million, right? And that is based on the PE ratio method that we are using, right? But if you remember the step 2 or the step 3, which said that you need to adjust downward to reflect the additional risk of an unquoted company, that yes, you took your average PE ratio, but remember that this average PE ratio was for the listed company, and listed companies are much more secure than unlisted company. And right now the company that you have, the company that you're talking about, foodie company, is basically an unlisted company, so it will have more risk. So what about the risk? Are you not going to adjust for the risk? So I'm going to say yes, I'm going to adjust from the risk. And how do you adjust for the risk? Just remember this small trick. Whenever you want to adjust for the risk, all you have to do is to just times your valuation of the business, whatever you got, 2.9 million, just times it by 1 over 2, which means half, or you can times it by 2 over 3, 2/3. Okay, so just take the 2/3 of your valuation of business. Okay, so if I do 2.9 into 2 over 3, that's gonna give me a value of 1.93 million. Okay, and if I do 2.9 into 1 over 2, 1 over 2, that's going to give me 1.45. Okay, so you can see that if I take the half of 2.9, that's going to be 1.45, and if I take the 2/3 of 2.9, that's going to be 1.93. So I can say that a fair valuation of this business should be around somewhere from 1.45 to 1.93 million, right? So that is the fair value that I can take for this company, the foodie company, right? Again, what did I do? That I had an unlisted company for which I didn't know the PE ratio. So what I did is that I choose some listed company operating in the same industry of the supermarket. Okay, I took their PE ratio, add them together, divided by 3 to get an average PE ratio of that industry. So we got an average PE ratio of 14.5 of the supermarket industry, right? So there's an average P ratio of 14.5. Then I times it by my EPS and I got $2.9 million as my value of the business. But again, this 2.9 million is not fair. Why? Because these companies are listed, which mean that they are much more marketable, number one, and number two, that they have less risk as compared to the unquoted or unlisted company. So therefore I adjust for the risk. I do the adjustment for the risk. So how do you do the adjustment of the risk? It's very simple. You just half your value. You say that, okay, if let's say it's $2.9 million, that's the value I'm getting, let's just half it. And why am I halving it? Because of the additional risk that is there in this company, because it's an unquoted company and it's less marketable. You cannot market the shares of this company, okay, just like you can for the quoted companies. So therefore I'm just going to halve this value, so I get 1.45. So I'm going to say that, okay, 1.45 is somewhat a fair value for this company. Okay, so just remember this, learn this, that you just half it or you just do 2 over 3, both of them acceptable, right? Just do 1 over 2 one time, just times it by 1 over 2 the first time, and the second time times it by 2 over 3. Okay, so you will have a range. You can see over here they have given you a range of 1.5 to 1.93. So you have a range and you can say that my answer is going to be somewhere from 1.45 to 1.93. And since it is a range, that means that if your answer is 1.45, that is also correct. If it's 1.93, that is also correct. And if it's somewhere between 1.45 to 1.93, that would be also deemed correct. Okay, so that's how you value a unquoted company based on the PE ratio. Okay, so you guys can see that this was the PE ratio method, and the PE ratio is used to value a business with the help of this formula. So if there's a listed company, you can easily get the PE ratio, but if there's an unlisted company, there's a little working that you have to do. There's a few steps that you need to follow, and that is exactly what we have learned in this example. Okay, now after that, let's discuss the problem and weakness of this method. So number one, it says that you have to use a proxy, right? So what does a proxy mean? Proxy basically means that these companies that you see over here, Morrison, Sainsbury, Tesco, right? These are all proxies, right? These are not actual, these are not my actual companies, right? These are other companies that I'm using for taking a guess about my PE ratio, right? So I'm using them to take a guess about my PE ratio, right? So I'm using them as proxy. We say that we are using them as our proxies. Okay, so that's what they're saying, that one of the very first problem of this method of using PE ratio to value a business is that you are using a proxy. So a suitable proxy may not exist. Yes, that can be a problem, that it's not always necessary that there are going to be similar companies that would be operating in the same industry as you are, right? If you are operating in a new type of business which is very new to the market, and you are one of the early adopters, right? So then there is going to be no competition, there are going to be no similar companies in the market. Then how are you going to use proxies? How are you going to get the P ratio for other similar companies, because there are going to be no similar companies, right? So that is one weakness of this method. The second weakness is that PE ratio, as you guys know, where does the values come from for calculating the PE ratio? What was the formula for PE ratio? That you take the market price and you divide it by the earning per share. So earning per share, market price, where does all this data come from? It comes from the balance sheets, right? It comes from the financial statements, it comes from the statement of profit and loss, statement of financial position, right? So that means that the earnings are subjective. So that's exactly what they're saying over here, that accounting earnings are more subjective than cash flow. Accounting earnings are affected by non-cash item, example depreciation expense, and accounting policy choices. So yes, again the same point, that because you are using financial statement, they are affected by non-cash items like depreciation and all that. So you know that accounting earnings have non-cash flow item also. Okay, so again that's one of the problems of this method, that you are also taking the non-cash items. So that is another weakness. The third one is that there are earnings manipulation. Obviously, I have repeated this point many times, that whenever you use the accounting figures, the figures that are present in the statement of financial position and statement of profit and loss in your financial statements, right? So they can be intentionally manipulated, right? And we know that. So that is again one of the weakness, that if they are manipulated, if the earnings are manipulated, then your EPS would be wrong. If your EPS would be wrong, your market price or the valuation would be wrong, right? So everything gets wrong. So that is again the third weakness of this method. The fourth one is that it's using historical data. Yes, again the same point, that because you are using financial statements, they are based on historical data, so therefore everything that you calculate from PE ratio to EPS, they are based on historical data and not the new data, okay, or the future data. So now the fourth weakness is that there is shareholder influence. It says a valuation based on earnings is less relevant for purchase of minority shareholder. Minority shareholders typically have limited influence to affect earnings. Yes, so basically this method of PE ratio is not very useful for minority shareholder. What is useful for minority shareholder is another method which is called the dividend valuation method, which I hope that you guys already know till now, because again this has been covered in the previous chapter. It's gonna be in this chapter also, right? But in the chapter where you learn how to calculate the cost of equity, over there dividend valuation method was also explained, right? Now in this chapter you are going to learn how to calculate value of the company using the dividend valuation method. So that is something that will come later. But my point was to just tell you guys that for minority shareholder, the dividend valuation method is much more better. PE ratio method is not very suitable for them because they have very limited influence to affect the earnings, right? As compared to the majority shareholders, right? Okay, then the 6 point says that loss-making companies, if the unquoted company is loss-making, the PE ratio method results in a meaningless negative value of for its equity. Yes, that is correct. So these are the weaknesses of the method, okay? PE ratio method. So I hope PE ratio method is clear to you guys. Now we are going to move to the second method, which is the earning yield method. But before we do that, this is the question that you guys can try yourself, or let me just do it. It says Tanglefoot Company is an unlisted company. Read this carefully. Tanglefoot Company is an unlisted company, unquoted company, the one that is not listed on the stock market. Its most recent earning per share EPS was 0.53. Okay, so the most recent earning per share is 0.53. Next year's EPS is forecast to be 10% higher. We do not care about that. Okay, we do not care. Just repeat after me. We do not care about the next year's EPS. We do not care about the next year's EPS. Don't tell us this irrelevant information. We do not need that. Okay, do not try to distract us. What is the thing that we need? We need the most recent EPS, which is 0.53. We do not need the next year EPS. Okay, do not distract us. Okay, let's move forward. Tanglefoot Company has 50,000 of issued average, the average price to earning ratio of similar listed firms, which is 12 times, okay, which are operating in the same business sector as your Tanglefoot Company. Okay, so good thing is that we have the average price ratio of the listed firm in the same business already given to us, so we do not need to calculate that, unlike the previous question. Okay, let's read what I have to do, right? So it says Required, estimate the total value of Tanglefoot company using the price to earning ratio method. So again, you have to use the price to earning ratio method to calculate the value of the Tanglefoot company, the business value, the valuation of the Tanglefoot company. So we are going to say, okay, we know that the market price per share is PE ratio times the EPS, right? So let me just replace it because they have written EPS first. So let's do like this, that EPS times PE ratio. Okay, so we know that EPS given to us is 0.53, the most recent one. We do not care about the next year. We just need to look at the most recent one, which is 0.53, and I times it by the PE ratio, which is 12. So I have my market value per share, which is 6.36. So this is market value per share, right? If I want my total value, I have to multiply this per share value with the number of shares, so I can get my total value, right? So what I'm going to do, first of all, I'm going to calculate the number of shares. And how do you calculate the number of shares? Very simple. You take your how much issued share capital you have, 50,000, and what is the nominal value of one share, 0.10. So you just divide them, 50,000 divided by 0.10. You have your number of shares, 500,000 shares. Okay, and once you have your number of shares, just times it by the market price per share. So you will have total value of $3.18 million. See, okay. This is how easy it is. Now they're saying that the sector PE ratio should be applied to the company more recent earning figure rather than the forecast earnings. Something that I just told you, that forget about the next year forecast EPS. We do not care about that. Just use the most recent earning figure, okay, which was 0.53. All right. The sector ratio would have been calculated based on the most recent published earning, and expected earning growth is reflected in the size of the price to earning multiple itself. So same point that I have just discussed, and you can see you guys have the total value. You have the total value of the company. So this is how simple it was. Okay. All right. Now moving to the second method, which is the earning yield. So now you are going to calculate the value of the business using the earnings yield, the earnings that you can yield from that business. That is what you're going to use to value the business. Okay. So remember that earning yield is simply the reciprocal of the PE ratio. Okay. So what was the formula for the PE ratio? Do you remember what was the formula for the PE ratio? That basically you take your market price per share and you divide it by EPS, right? This is the formula that we just learned at the top. Now, if I were to calculate the earning yield, what did I say? That earning yield is just the reciprocal of the PE ratio, which means it's going to be EPS over market price per share. So you guys can see that this is just the reciprocal of the PE ratio. Okay, that's it. So very easy to remember the formula, and don't forget that you times it by 100 because it's a ratio. Okay, so you times it by 100 and you get your earning yield. Okay, now if I have to replace, or rather I should say that if I have to rearrange this formula to get my market price per share, how am I going to do that? I'm going to write that market price per share is equals to EPS over the earning yield. Okay, and now you are not going to times it by 100. Okay, that is something you guys need to remember, that now you are not going to times it by 100. Okay, so EPS divided by earning yield, that's it. That's what you can see over here. Therefore, that we can calculate our ordinary share price or our market price per share by dividing EPS with the earning yield. Okay, this formula that I've written over here. Okay, so you can see, first thing, it's very easy to remember the earning yield formula. Just remember that earning yield formula is the reciprocal of the PE ratio. That's it, number one. Number two, that if I have to calculate my market price per share, just rearrange this formula. Market price per share would go in the earning yield place, and earning yield is gonna come in the denominator. So my formula is going to become market price per share is equals to EPS divided by earning yield. Okay, so this is how you value a business based on the earning yield. You're going to take the EPS and you're going to divide it by the earning yield. You will have the market price per share of the company or the value of the company. Okay, now this is activity number 2 that they have given on Study Hub. So let's have a look at this activity also. It says that Accredited company is an unquoted company, unlisted company, the one which is not listed on stock market. It says it has issued 400,000 ordinary shares of 0.25 nominal value. Its statement of profit and loss extract for the year ended 31st July 2004 shows profit before income taxes, which is 260,000, and then you subtract taxation from it, so you get your profit for the year. So we have all this data. Okay, let's just skip this. We have the PE ratio of similar type of business suitable for an unquoted company, which is 12.5. Okay, so they're saying that the PE ratio for similar type of businesses, which is suitable for an unquoted company, is 12.5. Okay, so we have the PE ratio of similar type of businesses. Okay, and we are going to use the same one to value our business in this question. But let's see what does the question require, because I don't know what is the question requirement right now. It says required value 200,000 ordinary shares in accrediting company on its earning basis. So basically using the earning basis, we have to value the accredited company, but we have to only value the 200,000 shares. We have to tell them that, okay, based on its earning, how much these 200,000 ordinary shares should be equal to, or should be worth. Okay, so that worth is something you have to calculate. So how would you calculate? You can see that there is no talk about the earning yield in the question. They have just given you the PE ratio. So since they have given you the PE ratio, you know that you're going to use PE ratio. That's it. You're going to use the PE ratio method to value this business. Okay, so now I'm going to write that, okay, I have 200,000 shares. Okay, because that's how much I need to value. Okay, and these are the shares. Okay, or should I do my own working? Okay, just do not look at this working. Okay, do not look at this working. Let's do the way that we learn, so you guys can easily understand. So first of all, what are you going to do? You're going to calculate your market price per share, correct? And how did we calculate the market price per share? Because remember, this question is related to the PE ratio. Okay, so how did we learn to calculate market price per share using the PE ratio? It's very simple. You take your PE ratio and you times it by the EPS, correct? So PE ratio, is that given to you? Yes, it's given to you for similar type of businesses, which is suitable for an unquoted company, as 12.5. Okay, and do we have our EPS? No, we do not have our EPS in the question, but what we do have is the data to calculate the EPS. Okay, so let's calculate our EPS. What was the formula for EPS? That you take the profit after tax, which is after subtracting the tax. So this is the profit for the year, or your profit after tax. Okay, this is your profit after tax, which is how much? Your profit after tax is 140,000. Okay, and from this we subtract any preference dividend which is paid. So you guys can see that we have two kind of dividend. We have preference dividend and we have ordinary dividend, but we are not concerned with ordinary dividend. We are concerned with preference dividend, because remember the formula for EPS, you take the PAT, profit after tax, and you subtract from it any preference dividend. Okay, so preference dividend is how much? 20,000. Okay, so you subtract 20,000 and then you divide it by the number of shares. So how many number of shares do we have? 400,000, right? 400,000 ordinary shares is the value that we have. So if I do that, let me just quickly calculate the value on my calculator. So 140,000 minus 20,000 divided by 400,000. Okay, so that is 0.3. That is 0.3. Okay, so you guys can see that I have my EPS as 0.3. Okay, I hope this is clear. Now let's go down and times our EPS of 0.3 with the PE ratio. So if I do that, I'm gonna get 3.75. I'm going to get 3.75, and this is my market price per share. Okay, so you guys can see this is the same way that we have learned, nothing new. Now I'm going to times this 3.75. I'm going to multiply this 3.75 with the number of shares to get the total value. And how many shares did we have to value? 200,000. Okay, so I'm going to multiply this with 200,000. So 3.75 into 200,000, that gives me a value of 750,000. Okay, so that's the total value. So you guys can see this is the same value that they're also getting over here, right? So we did the calculation according to our method, right? They did the same thing. Just that they multiplied shares in the same step. Okay, so they just did one step and they did everything in it, but I broke down into two steps so you guys can easily understand, right? First thing, I calculated the market price per share by multiplying PE ratio with the EPS, just like the way we learned. And once I had my market price per share, I times it with the number of shares so I can get the total value of the business. Okay, so that means that not the total value of the business, because over here we are just taking into account 200,000 shares, whereas in fact the company had 400,000 total shares in issue, right? So if I would have taken complete 400,000, then I would have said that that's the total value of the business. But since we are only taking 200,000 shares, because that's what the question requires us to do, so that means that this value that we got is for these 200,000 shares, right? So if the question asks me that what is the fair value of these 200,000 ordinary shares, so I'm going to say that the fair value of these 200,000 shares should be $750,000 as per the earnings of this company. Okay, so you guys see, this is how you basically use uh, PE ratio to value the business. Okay, so what we were learning, remember that this entire area, either you learn about the PE ratio or you learn about the earning yield. Okay, this entire area is basically which comes in which category? It comes in the category where you are taking the earnings, you are taking the income or the earnings of the company to value a business. Okay, so we have discussed the PE ratio, now we are discussing the earning yield. So back to the earning yields now. So we know that earning yields was the reciprocal of PE ratio, and then you can just rearrange this formula to get your market price per share. Okay, now we are going to discuss the weakness of this method. Of which method? Of this earning yield method that we are currently discussing. So we are going to discuss the weakness or the problem of this method. So it says that there is variability in yield. What does yield mean? Yield means that how much earning you can, get from your, based on your investment in that company. So that's the yield. So that earning that you can get from that, from the investment in that company basically varies. Okay, so earning yields can vary significantly, not by small margins, but significantly over time. So it's not a stable valuation metric. It's not a stable valuation metric, and it may be a challenge to interpret. Okay, so that's exactly a very fair point, that if you are using earning yield to value a business, then you should remember that earning yield, it's not stable. It's not stable like the PE ratio. It's not stable like the PE inverse economic indicators. If the company, has very bad political stability, and it has very low investments, and there's a very, bad economic condition in that particular country, then the company would also, because it's operating in the same country, so it would have the reflection of those things, and therefore the earnings would go down. So the earning yield is not stable. Therefore you cannot, actually it's not a very good way to value a business, because you are valuing a business based on something which can vary over time. So that means that over time your value of the business can also change. So what kind of valuation is that, right? So again, that's one problem. The second problem is, if there are high interest rate, an earning yield may appear attractive but it not be competitive compared to the other investment where interest rates are high. So yes, earning yields can improve if the interest rates are high, right? So that means that if your earning yields are good, they are attractive, and you just take that to value your business, then the value of the business is also going to be good, it's going to be attractive. But again, that's not based because of the, that's not going to be a fair, you can say, way of valuing it, because it's based on the interest rate. Because the interest rate are high, that's why the earning yields are good, rather than, the performance of the company. So again, this is one limitation. And the third one is earnings quality. Reported earnings may not be high quality, and unsustainable earnings may lead to inaccurate valuation. So it's pretty much the same point as the first one. Then it says non-earning factors. Other factors that may be important for investors are ignored, obviously, like dividends, company management, competitive advantages, the industry specific risk. Everything is ignored, because now you are just valuing the business based on the earning. That's it. So you just take the earning and you say, oh, earnings are the ones that are going to tell us the value of the business, and every other factors like dividends, company management, is the company management good or bad, is it, does it have any competitive advantage over the other competitors, does it have any, industry specific risk. You just close your eyes on all these factors, and you say, oh, no, no, we don't care about that, we only going to value the business based on an earning. So that is again a very big weakness of this method. Okay, so these are the four weaknesses. You guys can have a look at them again, you can read them again. Okay, now after discussing the earning yield, we are going to focus on the cash flow based valuation first. So we have the cash flow based valuation. Now cash flow based valuation is where you use the actual cash flow and not the accounting profits and the accounting values which can be manipulated. No, you are going to actually take the cash flows, the actual cash flows, to value a business. And on that list, the first one that we have for our ordinary shares is a method called the dividend valuation method, and that is exactly what we are going to discuss now. So something which you guys would have studied in the previous chapters, right? So now in the previous chapter, what you guys would have studied is that how to get the cost of equity by using the dividend valuation method, right? But in this chapter, you are going to study how to calculate the value of the business using the dividend valuation method. Okay, so remember that dividend valuation method basically says that we are going to value the business based on the dividend it gives. So whatever dividend the company is giving, we are going to use that to basically value our value the business that we are trying to invest in. Okay, so if dividends are forecasted to grow at a constant annual rate to perpetuity, the valuation formula as introduced in chapter number 10 is P naught is equals to D naught 1 plus growth over RE minus G, right? So your D naught is the most recent dividend, 1 is constant, and then we have plus G is your growth, right? That's the required return of equity investors, your RE, okay? And the PO or the P naught is basically your current share price, okay? Note that D naught 1 plus growth is the dividend in 1 year. Yes, so something you guys would already know because you would have gone through chapter number 10. So this is something that is explained in detail over there. But let me just give you guys a brief that basically this D naught 1 plus growth is equals to D1. Okay, remember that. And your D naught, your D0 is basically the most recent dividend. Okay, whereas your D1 is the dividend which is of the future, right? So dividend that is going to be paid in 1 year or after 1 year or in the following year, right? So they use these words interchangeably to give you your D1. Okay, but D naught or D0 is basically the most recent dividend. Okay, so this is the formula that you guys can see in front of you, that P naught is equal to D naught 1 plus growth over RE minus G. Okay, and how do you value the business based on this? So let's just jump to an example and I'm going to explain to you from that. So over here you can see it says Cross Company, which is an unlisted company, has just paid a dividend of $0.12 per share. Its historical dividend growth rate of 5% is expected to be maintained. The following is available for a suitable listed company. Example, same business and same gearing, share price, dividend just paid, historical dividend growth rate is given to you, which is 10%. So basically they have told you that Cross is a company which is unlisted and it pays a dividend of $0.12 per share. Okay, its historical dividend growth rate is 5%, but what they have also given you is the share price, the dividend just paid, and the growth rate of same business, but they are listed. So this is the data of proxy companies, right? They would have selected a single proxy company operating in the same industry like the Cross Company, and they have given you data for that company. Okay, now what is required from us is to calculate the share value of Cross Company. So how am I going to calculate the share value of the Cross Company? So share value basically means the value of the business. Okay, so how am I going to calculate the share value of Cross Company? It's very simple. I'm going to use my formula, right? But the problem is that if I use my formula, you guys know that what do I need? I need my most recent dividend, which is 0.12, right? Then I times it by 1 plus growth. So growth is given to me as 5%. Okay, and then from this I subtract my required return of the investors with the growth rate. Correct? That's exactly what we do. Correct? But the problem is, do you have your RE? Do you have your required rate of return? No, you don't. So if you don't have that, how are you going to value the shares? How are you going to value the share of the Cross Company? So that's why they have given you the data of this proxy company. So you're going to use this data of the proxy company to calculate the RE, and then since you have the RE, you are going to use the same RE for your company, because hey, it's the same industry, right? So if there's an investor and his required rate of return is, let's say for example 5% from this company. Now this company is the same, it's from the same industry, so I can take that required return from my company also, right? It's fair, and that's exactly what we do. Okay, so that is exactly what we are going to do here. We know that the share price is 2.40, so I'm going to keep that as P naught. Okay, I know that the dividend just paid is 0.22. Then we have 1 plus growth is 10%, and I'm going to divide it by RE minus the growth rate, which is 10%, right? Now you can just rearrange this formula to get your RE, right? So if you rearrange this formula and you calculate your RE is gonna be how much? You can see over here your RE is gonna be 20%. Okay, they have already calculated it over here in this step. You guys can have a look. Okay, so my RE is gonna be 20% or 0.2. Okay, now since I have my RE, I'm going to use the same RE, which is 0.2 or 20% for the calculation of my value of share, my P naught for cross company. Okay, so my P naught is gonna be equal to, if I solve this, you guys can see that they have done over here, it's $0.84. Okay, so your P naught is $0.84. Okay, so basically what we have done is that we wanted to calculate the share value or the P naught, the market value of our cross company, and over here we are using the dividend valuation method to do that. So I said that okay, according to the formula of dividend valuation method, I have to take my current dividend that the company just paid, 0.12 times 1 plus the growth rate, which is 5%, divided by my RE minus growth. But as soon as I reach the denominator, I realized the fact that I do not have the RE. So what I did is that I used the proxy company data that they have given me to calculate my RE, and I used the same RE for my company. Okay, I said that okay, if a similar company has a required return of this much, then obviously my company would have the same required return rate because it's in the same industry. Okay, so I can use the same RE. So I use the same RE, and that's how I got my market value for this particular company called as the cross company. Okay, so you guys can see that this is how you use the dividend valuation method to calculate the value of any business. Okay, moving forward, now this is an example of CAPM. Okay, the CAPM method of valuation. Again, I expect from you guys that you would have know till now that what is CAPM, because there's a whole chapter which covers this, right? So I hope you guys have gone through this chapter before coming to this chapter. Okay, so that's my assumption, and since you guys know what is CAPM till now, let's look at what the question says. The question says that Wave Company, which is an unlisted company, is entirely equity finance. It is entirely equity finance, because this means that there is no debt. There is no debt in the company, so therefore the company is entirely equity finance. So this line is very important. Okay, then it says it has just paid a dividend of $0.12 a share. Its historical dividend growth rate of 5% is expected to be maintained in future. The following information is available for a listed company in the same business. You have dividend to equity ratio, you have the beta. Okay, so again they are using a listed company, a proxy company, and they are telling you that a same company operating in the same industry but is listed has this information. It has debt to equity ratio, and it has beta. Okay, then it says that the risk free rate is 5% and the return from the market is 15%. The company profit tax rate is 25%. You are required to value the Waves company equity. Okay, so the thing is that I have to get the value. I need to calculate the business value, right? And as you guys can see that they are discussing about the dividend, they are discussing about the growth rate. So that means that we will have to use the dividend valuation method to calculate the value of the business. But the problem is, again, in this question would be that you do not have the RE. You do not have the RE, right? Just like the previous question. So let me show you. If I use the dividend valuation method, you guys know I need the most recent dividend, which is 0.12. Sorry. I need the most recent dividend, which is 0.12, right? Then I do times it by 1 plus growth, correct? Then I times it by 1 plus growth, right? I times it by 1 plus growth. So 1 plus growth. Do I have growth? Yes, I have growth, 5%. and then I divided by the required return minus the growth. So I have the growth, but I do not have the required return. So that is exactly why they have given you all the data for CAPM. So you are going to use the CAPM valuation to get your RE, and once you have your RE using the CAPM valuation method, that's when you are going to substitute that in this formula, and then we use the same RE to calculate the value of the company, which is unlisted. Okay, over here they have just changed a question a little bit, and instead of giving you the dividend valuation method to calculate the RE, they have given you the CAPM valuation method to calculate the RE. So you're going to use the CAPM valuation method, you're going to calculate the RE, and once you have the RE, you're going to substitute that into the denominator, and that is exactly how you are going to get your P naught. Okay, so let's just look at the working. We are going to just quickly go through the working because I'm assuming you guys already know how to do that, right? So RE is equals to RF plus, the beta, and then, the market return minus the free rate. That's how you get your RE, which is 21%. Okay. But obviously for calculating the RE, you need the beta asset. And for beta asset, you have to do all this working, which is 1.23, right? So you guys would know all those steps where you ungear and then you re-gear, right? But over here, you do not need to do the re-gear since the company is 100% equity finance, right? There is no debt, so therefore you do not need to do that step where you have to re-gear, right? So that means your beta asset would be equal to your beta equity, correct? In this particular example. So that's exactly what we have done. We have just kept our beta asset as 1.23 into the question, as you can see, right? And we got our RES 17%. We got our RES 17%. We got our RES 17%. Okay. So this is the steps that you guys have to follow to get your RE. And again, I'm not discussing this in detail because I'm assuming that you guys already know how to calculate the return on equity using the CAPM method. Okay, so that's why I'm not going to discuss this in detail. Okay, so since I now have my RE, I'm going to substitute that. It's 17%, which means 0.17, right? So I'm going to come over here and I'm going to substitute 0.17 in place of RE, and that's how I'm going to get my P naught. So that's exactly what they have done over here. Look, exactly the same working that I did, right? And they got P naught as 1.05. Okay, so that's how you solve your question. Okay, I hope that is clear. Now this is a very important activity that you guys need to check. First of all, remember that if there is no growth in the dividend, okay, so we are going to look at 4 different scenarios, and all these 4 are very important. Okay, so focus on the question very carefully. It says that Clay Grow Company is a company with manufacture flower plots. The following information is available. We have the current dividend, which is $0.25 per share, and we have the required return on equity in the risk class, which is 20%. Okay, what you are required to do is that you have to calculate the value of one share in Clagro company under the following circumstances. So the part number A says that if there is no growth in dividends, so first of all, what we have to do in part number A is that we have to calculate the value of one share in Clagro company if there is no growth in dividend. Okay, so if there is no growth in dividend, then you do not apply this typical formula that we have learned. You do not apply this. Rather, since there is no growth, right? So this obviously this formula is irrelevant because this formula is growth in it. But if there is no growth, then this formula becomes irrelevant, correct? So therefore, the formula that we use in these cases is very simple. We just take our P naught and we say that our P naught is equals to the D naught, which is the most recent dividend paid, okay, divided by KE or RE, okay, the return on equity. Okay, so you just do this formula and you get your P naught, your value. Okay, if there is no growth in dividend, it's specific to the requirement if there is no growth in dividend. Okay, so what's our D naught in this question? You can see it's the current dividend, which is 0.25, and what's the required return on equity? That's 20%. So that's why you see a 0.25 divided by 0.20 and you get a $1.25 value of one share. Okay, so pretty simple. Okay, now part number B, if there are constant dividend growth rate of 5% per year. So now we are looking at an area if there is dividend growth but the dividend growth is constant. If there is dividend growth but the dividend growth is constant, right? So if the dividend growth is constant, what you can do is that now you're going to use this formula. Now you're going to use this formula. Now you're going to use the same formula that we have been using, because now they are talking about the growth and the growth is constant. Okay, so you can see we have used the same formula. We have our most recent dividend, which was 0.25, right? You can see over here 0.25. Okay, and you times it by 1 plus growth. Where did I get the growth from? The question says it's 5% over here, right? So 5%, so 1 plus 5% divided by RE minus G. So RE, as you guys know, is 20% minus G, which is the growth rate. So you got your P naught as 1.75. Okay, so if there is no growth in dividend, you use the simple formula D naught over KE, and if there is growth, then you use this formula, and the growth should be constant. Okay, now part number C says that constant dividend for 5 years and then growth of 5% per year to perpetuity. Okay, constant dividend for 5 years and then growth of 5% per year to perpetuity. So that means that for the first 5 years, the dividends were constant, and then from after 5 years there is a growth of 5% per year till perpetuity. Okay, so how do you account for that? Remember that in this case you guys have to calculate the present value. So first of all, what you're going to do is that you're going to calculate the present value of the first 5-year dividends, right? So you guys know that the first 5 year the dividends were constant. Okay, the dividends were constant and the dividends are going to be 0.25 per share. So we had 0.25 in year 1, in year 2 we had 0.25, in year 3 we have 0.325, in year 4 we had 0.25, and in year 5 we had 0.25. So for the first 5 years the dividends were constant, 0.25, 0.25, 0.25, 0.25, 0.25. So what I'm going to do, I'm going to apply the annuity factor over here. I'm going to apply the annuity factor since the flows, the cash, since the dividend are of the same amount, so I can apply the annuity factor, right? So I know that the amount of my dividend is 0.25, and the annuity factor that I'm going to use is gonna be from 1 to 5 years, right? 5 years at a rate of 20%, right? So 20%, 5 years at a rate of 20%, right? 5 years at a rate of 20%, that is exactly what I'm going to calculate as my annuity factor. So I'm going to go at my table. I'm going to go at my annuity factor table. I'm going to look at the value for 5 years at 20%, and that's going to be 2.991. I'm going to times this 2.991 with 0.25, and I'm going to get my present value of the 5-year dividend as 0.748. Okay, so that's the first thing that you do, that you calculate the present value of your dividends which are constant. Okay, now from 5-year and onwards there is a 5% growth. From 5 years, or you can say from 6 year onwards, a 5% growth per year to perpetuity. There's a 5% growth per year to perpetuity. Okay, so now what you're going to do, now you're going to use this formula. Since there's growth, and you're going to write that our dividend right now is at 0.25, and then there's going to be a growth of 5% divided by the required return is 0.2 minus the growth. Okay, so you will have your new value of the dividend based on the growth. You're going to have your new value of the dividend based on the growth. Once you have your new value of the dividend based on the growth, then you're going to multiply it with the discount factor. Okay, you're going to multiply it with the discount factor. Okay, and it's gonna be again at 20% discount rate. Okay, for how many years? For 5 years. Okay, so if you do that, then you will have your present value of dividend from 6 year onwards, which is gonna be 0.703. Again, why did we multiply it with discount factor? Because you need the present value. Okay, just like the way we did over here. Okay, but we use the discount factor over here because there was an uneven cash flow, right? Over here we had even cash flows, right? So we use the annuity factor, but over here we had uneven, so we are using the discount factor. Okay, very basic. I hope you guys already know this. Okay, so 0.703, that's one value that we get. We can round it off to 0.70, right? And then 0.748, can be rounded off to 0.75. So 0.75 plus 0.70, that's our total value 1.45. Okay, so this is how you are going to calculate the value of the share if there are constant dividend for particular years, and then the dividend is going at a constant rate until perpetuity. Okay, this is how you do that. Okay, so this is part number C. Again, that's why I'm again and again saying that this is very important for you guys to remember. Okay, based on the specific scenario, that if there is no growth in dividend, what I'm going to do. If the constant dividend growth, then what do I do. If there is constant dividend for a particular number of years and then there's a growth of whatever till perpetuity, then what I'm going to do, right? So you guys need to remember these specific scenarios because they are tested very frequently. Okay, now part number D says that if there's a constant dividend for 5 years and then sale of the share for $2. Okay, so the first part is the same as part number C, that the dividend are constant for the first 5 years. And then there's a sale of the share. Then you are selling those shares for $2. Okay. So how do we account for that? It's very simple. First of all, the first working remains the same, just like in part number C, that you're going to take 0.25 and you're going to times it by the annuity factor at 20% for 5 years. Okay. So you get your present value of 5-year dividends as 0.748. And now after 5 years, there is no growth. Rather, you are selling the shares. You are basically selling the shares. So you are going to just take the amount of the selling of those shares. So you sold those shares for how much? For $2. Okay. And you're going to discount this $2 to calculate your present value, that how much is this selling price going to be equal to in today's term, right? So for that you have to just times it by discount factor so you can get your present value. Okay, so I times my $2, I multiply my $2 with 1 over 1.2 to the power of 5 to get my discount factor, right? And then I have my present value as 0.804. Okay, so what are my total cash flows? I have my 0.748 present value of dividend, which is 0.748, which can be rounded off to 0.75, right? And I have my present value if I sell the share, which is 0.80, and if I add them together, I have my total value of 1.55. So you can see that's my total value. Okay, so this is how you deal if you have a constant dividend followed by a sale in the 5th year or the 6th year or the 7th year, depending on the question. In this case of a 5th year, so this is how we solved it. And these are 4 different scenarios that you guys need to understand, that you guys need to remember. Okay, because again and again I'm saying these are very important, they are frequently tested. Okay, so I hope this activity that I just explained was useful. Okay, now moving forward to the activity number 4. So it says that value using dividend growth model. So again, this is an activity number 4. This is another question. You have your current EPS, you have the payout ratio, you have number of shares in issue, you have net assets and statement of financial position. You have all this information, and what you're supposed to do is to find the value of company equity using the dividend growth model. Okay, so first of all, if you want to use the dividend growth model, you need the, first of all, you need to calculate the current dividend per share. Okay, because you know that in this formula you use the current dividend. Okay, so in order to find our D naught or our current dividend, what we will do, that we will take the 0.30, which is our current EPS, and we are going to times it by 0.4, which is basically our payout ratio, right? So if you times your EPS, the earning per share, with the payout ratio, you get your dividend per share. Because see, EPS, your earning is 0.30, right? Your EPS is 0.30, and what is EPS? EPS is basically your profit after tax per share, right? So that's 0.30, and from this 0.30 you are going to distribute the dividends. Right? And how much dividends are you going to pay out? So you have a ratio for that. You're going to pay out 40% of this EPS as your dividend. Okay, so that means 0.4. So I know that the dividend that I'm going to be paying, or the company is going to be paying, is going to be $0.12. Okay, again, the company has an earning of 0.30, and out of this earning the company is going to pay 40% as dividend. Okay, so I just said that, okay, what's the 40% of my earning? That's 0.12, so that's my dividend. Okay, that's my D naught, and you guys know that we need D naught in order to calculate our market value using the dividend growth model, right? After that, what's the second thing that we need? The growth, right? You need the growth. Do you have the growth in this question? No, you do not. But I hope from the previous chapter you guys know that you can calculate the growth by using this formula, BRE, right? So that's exactly what we are going to use. You guys know that first of all we are going to calculate our return on equity. So this is exactly the formula that we'll be using to calculate the growth. Okay, again this is something I'm not going to explain in detail because this is covered in the previous chapter, and I'm assuming that you guys already know that. Okay, so what is my return on equity? I can easily calculate that. I have to calculate the profit for the year, and profit for the year, you guys know that my earnings are 0.30 and the shares in issue is 5 million, so that means a total earning of 1.5 million dollar. And since I have my total earning of 1.5 million dollar, I am going to divide it by my net assets in the statement of financial position, which are 12 million. Okay, so you divide your profit for the year with your net asset. That's how you got your return on equity, right? That's how we learn to get our return on equity, correct? So that is 12.5%. Once you have your return on equity 12.5%, now you need what? You need the required return rate, right? Now I have my return on equity. What's the second thing that I need? I obviously need my retention ratio, because you guys know that in this formula the retention ratio is multiplied with the return on equity. So I have my return on equity. Now all I need is my retention ratio, and I can easily calculate that by subtracting my payout ratio. So I'm going to subtract my payout ratio with 1, and that's how I'm going to get my retention ratio, because it's very simple. If you are paying out 40% of your earning, how much are you retaining? 60%, that's it, right? So 60%, which is 0.6, times it by the return on equity, which is 0.125, you get your growth rate as 0.075 or 7.5%, right? Using this formula, correct? So now I have my growth, which is 7.5%. I have my dividend, which is 0.12. What else do I need? Now I need the, right? I need the return, so that I can apply my formula that we learned for dividend valuation method and calculate the value, right? So I will now calculate my required return. And how do I calculate my required return? I'm going to look at the data, because the data speaks for itself. The data speaks for itself, right? So you can see in the data I have the risk-free rate, I have the market premium, I have the equity beta. So these are all the information for CAPM, and we know that if they have given us this, that means they are basically asking us to calculate the return on equity based on CAPM. So that's exactly what we have done. We apply the CAPM formula over here, and we got our return on equity as 11%. Now I have all the ingredients that I need to calculate my share value, my P naught. So that's exactly what I'm going to do. My D naught is 0.12 times 1 plus growth. Growth is 7.5%, divided by RE, which is 11%, minus the growth rate, which is 7.5%. Okay, so you guys can see this is exactly what they have done over here, and we got 3.69 as our share value. Okay, we got 3.69 as our share value. Okay, so now this is the value of one share, but we need the company's total value, right? So that means that we will times it by the number of total shares that we have, which were 5 million. So 3.69 into 5 million, so we have a total value of the business as 18.45. So there is one more full flash question that I have discussed with you guys. Okay, a full flash question. Okay, where we had to calculate almost everything: the dividend, the growth, the return on equity, everything. Okay, so first we calculated all that, and then we applied our formula to calculate the value of the business based on the dividend growth model. Is that clear? Okay, now we have example number 4, which should be the last example. It says that KIP company has paid the following dividends per share in recent year. We have year 2006, 2005, 2004, 2003, and we have dividend per share as 0.65, 0.638, 0.628, 0.611. Okay, They are saying that the dividend for 2006 has just been paid. The dividend for 2006 has just been paid. KIP company has a cost of equity of 12%. Okay. Calculate KIP's company's share price. Now, first of all, in order to calculate the share price, do I have my D naught? Yes, I have my D naught. They just told me that the dividend for 2006 that has just been paid is how much? 0.65. Okay. So I'm going to take my 0.65 as my D naught. Why? Because again, they have said themselves that the dividend that you see for 2006 has just been paid. So that means that is my D naught. Okay. Now what do I need? I need the RE. Do I have my RE? Yes, I have 12%. What's the third thing I need? The growth. Do I have the growth? No, I do not have the growth. So that is the first thing we need to calculate before we calculate the share price or the value of the business. Okay. So for that, we use this formula. We use this formula because remember that whenever you have a question like this where they have different dividends in different years, right? You always use this formula to calculate your growth, and the formula goes something like this, that you take the most recent dividend. You know, this 2006 dividend, you are going to ignore this. Why? Because this is something that you have already taken as your D naught. This is something that you have recently paid, right? You are going to take the one that is the second most recent, which is 0.638. Okay. And you divide it by the earliest, which is 2003 dividend, which is 0.611. Okay. And then what you do is that you take the cube root of that. You're going to take the cube root of that. Why are you going to take the cube root of that? Because these are 3 years. 1, 2, 3. These are 3 years. 1, 2, 3. 3 years. Okay. Ignoring this, because this one, just ignore it, because we have already taken that as D naught. Okay. So just ignore it. So what we did again, we took our second most recent dividend, divided it by the earliest dividend. Okay. And then we took a cube root of the entire fraction. Why? Because these were 3 years. 1, 2, 3. Okay. And now from that, you are going to just subtract 1. So this is the formula that we use. So if, for example, there had been 2 years, you would have taken the square root instead of cube root. If there had been 4 years, then you would have taken the 4 root instead of cube root. Okay. So that's how it changes. Okay. And the division always remains the same, that you take the second most recent dividend and you divide it by the earliest dividend. Okay. And then subtract it by 1. So this is the formula that we use. And by that, we get a growth of 2.1%. Okay. So this is the formula that we use. Remember that whenever we have such scenario, whenever we have different dividends with respect to different years. Okay. So that's how you calculate the growth. Once you have the growth, now everything we need is there, right? So we are going to just apply the same formula, which is D naught 0.65 times the 1 plus growth. Growth is 2.1%, divided by RE, which is 12%, minus the growth, which is 2.1%. So in that way, we okay. So this is activity number 4, and with that, the dividend valuation method is also completed. Okay. Now for today, we are going to keep the class till here. We are going to continue our next lecture from here onwards. Okay. And in that lecture, I will try to complete this entire chapter. Okay. Right now, for this lecture number 1, we are just going to keep it till here. Let's just quickly see what we have discussed so far. So for valuing a business, we saw that there were different methods. So far what we have covered is the first category, where you value your business based on asset. In that, we discussed the net book value method, the realizable value method, and the replacement cost method. Okay. Then in the income or earning based valuation, we have discussed the PE ratio method and the earning yield method. Okay. Dividend yield method is right now not in our syllabus. Okay. Then for the cash flow based valuation, we have discussed the share based valuation, in which we have covered the ordinary share, the dividend valuation method. Okay. Now we are left with the debt. Okay. And we are left with the preference shares. So that is something we are going to cover in the next video with the theoretical area, and with that, this chapter would be completed. If you guys like this video, please share, subscribe, and comment if you have any problem. Okay. You guys can see my WhatsApp number on the screen. You can directly WhatsApp me and I'll try to respond to you guys as soon as possible. But please, if you find this video helpful, remember that the only way to keep me motivated and support me is to like this video and subscribe this channel. Just share it as much as possible, so I can be more motivated to produce similar videos for you guys. Okay. So for today, let's just keep it till here, and I'll meet you in the next lecture. Till then, take care. Goodbye.